Hi everyone, I am management consultant by profession and today I want to talk about risk minimization strategy in stock market because a lot of retail investors end up incurring huge losses simply because they don't have clear-cut strategy around investments and growing their portfolio. So let's get started. A quick fact, 90% of the retail investors lose their money in stock market and which is substantiated by one of the largest brokers in India and they have data from tons and tons of retail investors. And the reason being, most of their decisions are driven by news, fear, or greed. Hence, they take speculative trading position and end up losing money and start believing that stock market is risky and only for lucky people, which is not true. So let's try to burst this myth. I only do occasional swing trading, but majorly I do long-term investment and I have been doing this since last 6 years. Over the years, I have built a strategy with my investing experience. Of course, I have made mistakes, but through this strategy, you can avoid it to a very large extent. The strategy which I am going to talk about is called 3 into 3 risk minimization matrix strategy. So let's get into it. First, I'm going to talk about some key principles. So let's call it as primary principles and let me know in the comment section how many of these principles do you follow. The first one is 5% principle. Now, what is 5% principle? So imagine if you have 50,000 rupees worth of portfolio and if you want to add 10,000 more to your overall portfolio, how should you go about it? This is what this principle will guide you. Imagine you invested that 10k in single business ITC. Now ITC is fundamentally a great stock choice and in last 5 years it went up till 300 levels as well. But if you look at the graph around May 2016, the stock was trading at the levels of 2020 and now also the stock is trading at around 225 levels. So essentially a cumulative 5-year gain is roughly 3%, which is lower than a FD. This simply proves that we should not invest more than 5%, else we might end up with a stock which gives low return despite being a great stock. Let's look at another stock, Asian Paints. Now look at Asian Paints. It is one of the best stocks trading in Indian stock market. Now imagine that you wanted to invest in Asian Paints and you invested that 10k in a single stock at this instance, thinking that it is trading below 200 days moving average and it is a great opportunity. No doubt about it, it's a great opportunity and you should have invested at this point in time. But my only point is that you should not go in and pour all your money at one go at this point. Instead, you should wait for a few more trading sessions and then see if the stock is falling further and then take one more position here, then take one more position here. So in this case, you can average out a falling stock and also end up having a great stock in your portfolio at a very discounted price. And this would have ensured that even a fall of 18% would have not hit your portfolio severely. So I think 5% principle is a great principle and you should always stick to it. You might give an argument that great investors like Warren Buffett have very concentrated portfolio. They invest around 50% of their portfolio in single stock like Apple, and we should also have a similar strategy. But then you should also take into the consideration that they are ace investors and they have massive army of professionals who are doing research day in and day out, and they are able to get information which as retail investors are not available to us at the right time, and hence we might end up with stocks which gives very low return. So hence we should always minimize our risk and not invest more than 5% in a single stock. Now the next principle is fundamentals plus 200 daily moving average. This answers the question that when should we buy or add a new stock. You only add if stock is fundamentally sound and is trading below 200 daily moving average. What is 200 daily moving average? This simply tells you about average price of stock in last 200 trading days. Next question you might have is, what is fundamentally sound stock? This is very big topic in itself, but I will tell you in very brief. Now, if you look at HUL, the ROCE for this stock is 39.2%. Essentially, this means that if you give 100 rupees to the management of HUL, then management of HUL can give you a return of 39 rupees. Now, let's quickly look at its P&L statement. In last 5 years, the sales number has gone from 32,000 crores to 51,000 crores. So essentially, the revenue numbers are increasing year by year and there is fundamentally no problem with the stock. People are buying their products and they are able to sell their products as well. If you look at the net profit in last 5 years, it has gone up from 4,000 crores to 8,700 crores. So the profit numbers has almost 2x in last 5 years, which itself is a growth of almost 12% year on year. In the last 5 years, the debt also to the company is very low. The only time they have incurred some debt is during the pandemic, which to a certain extent can be justified because the entire economy was in shock. Let's quickly look at the cash flow statement. If you look at the cash flow statement, in the last 5 years, the numbers has gone up from 4,000 crores to 9,000 crores. What is cash flow? Cash flow essentially tells you that for business to continue their operations, do they have cash in hand which they can use to finance their operations, which almost guarantees you that in next 1 or 2 years the company is not going to default in any of its payment and it's going to stay in the market. So you can be rest assured that your investment is safe. Now, assuming that we agreed that this stock is fundamentally sound, the next question is, when do we buy it? You should only buy it when it is trading below 200 daily moving average. So in last 5 years, when did we get the opportunity to buy this stock? Answer to this is very simple. So if you look, so you got the opportunity to add into this portfolio around November. Next opportunity was given in May, June 2019. Then you got the opportunity in March 2020 when the COVID wave hit the economy. Then you got opportunity to add it in October 2020. Then you got opportunity to add in March 2021. Then you got the opportunity to add it in October 2021. And now the stock is trading far below its 200 daily moving average, and it is one of the best stocks to buy right now. So stocks like HUL are very defensive in nature. Stocks like HUL rarely fall below 200 daily moving average, and the reason why stock has fallen almost by 22% is because of Russia-Ukraine war. It's a right opportunity to add this stock in your portfolio simply because it is trading at discount. The fundamentals of the company is still intact, but then again, if you are investing for the first time, don't go and pour in all your money at one go. Now, the third most important primary principle is to diversify. This principle simply tells you that you should stay diversified across sectors, market, and categories as well. So essentially the rule is that you don't keep all your eggs in one basket. Rule 2 is to diversify and hedge across sectors, individual stocks and markets as well. So what do I mean by across sector? So what I mean is that if you are investing in PSU bank, then you should also add some private sector banks. So if you look at this chart, this is Nifty IT and it is composition of top IT companies. Similarly, the trend line in orange is Bank Nifty, which is essentially top banks trading Indian Stock Exchange. Likewise, the blue one is Nifty Auto Index. Now, this is what sectoral diversification means. So imagine if you had invested only in auto sector, you would have not made significant profit. But if you had invested in banking stocks, then you would have made slightly higher profit. And if you had invested in IT stocks, then you would have made massive profit. Now the problem is we cannot predict the nature of these sectoral moves, and hence we should stay diversified so that whenever a bull market happens in a sector, we are part of it. Now these three are my primary principles. Now I want to explain few more secondary principles as well, which will help you understand these principles even better. So the fourth principle is copycat investing. Now what do I mean by copycat investing? To understand this, let's look at a short clip.
Would not like to pay much money for companies who have perceived large markets and good positioning in that market, but no cash flows or very little cash flows.
Now, if I read between the lines, what Mr. Rakesh Jhunjhunwala is saying, that he is not believing in some of the companies which have got super high valuation and are not generating enough cash flows to support their operations. Let me help you understand this through some example. Though he has not explicitly said about this company, but what I believe is that he is inferring to new age technology firms which have recently listed on Indian market. Now, if you look at Paytm, it has got a market cap of 50,000 crores. So right now, its valuation as a listed firm in Indian market is 50,000 crores. But at one point, it was listed at a valuation of 1,40,000 crores. So almost one third of the company has been wiped off from Indian market. And let's look at the chart. From the listing price of 2100, it has come down to 750, which is almost 60 to 70% reduction in their valuation. And if you look at their cash flows, it is a loss making company and they are not able to even fund their operations as well. And that is precisely what Mr. Rakesh Jhunjhunwala was saying, that some of these firms has got ridiculous valuations and he's not believing into those stories. And same is the case with Zomato as well. If you look at Zomato, from its listing price, it has almost fallen by 30 to 40%. Very quickly, I just wanted to show this. Imagine Tata Motors, which is synonymous with lot of famous cars in India. They themselves are valued at 150,000 crores. Now compare it with Paytm. Do you believe that Paytm adds so much value in your life as compared to what Tata Motors is adding to the Indian society or to the country? At least this narrative of Mr. Rakesh Jhunjhunwala, I am able to buy. But I am not recommending you to follow them blindly as well. And why I am saying this, I will explain in the next principle, which is recency bias. Now, what do I mean by recency bias? Now, take a look at this news headline. It immediately triggers a fear of missing out, and the next what you do is that you pour all your money basis these kind of news. Now you should always remember that your profit always depend upon your entry point. Whenever a news like this comes up, it's always too late. People like Mr. Rakesh Jhunjhunwala have huge resources and they take their bet basis the recommendations from hundreds of analysts, and only when they have acted on those recommendations, news like this are peddled outside. You should also not pay a lot of attention to any kind of multi-bagger stock kind of recommendation as well. See, you also have to understand that there are a lot of operators in any market, and the job of these operators is to simply pull a stock up or pull a stock down. Now, how do they do it? They peddle news like this and influence the retail investors who act on the basis of their fear of missing out and end up making a huge losses. So this is one of the most important principle, that you should not act basis what you read or what you hear, because it's human tendency to act on recent events. Now the last principle is top 3. Now what do I mean by top 3? Now in the third principle, I had told you that you should diversify. Your next logical question should be, where do I diversify? So suppose you want to invest in a car manufacturing company and you invested in Tata Motors, but then you also want to diversify into other car manufacturing stocks. So what I'm simply recommending through this principle is that you should not go beyond top 3. So if you look at this page, these are the top 3 cement companies in Indian market. All I am saying is that you should invest in top 3 companies in their segment. Now this could be a very tough principle, and it is only for people who don't want to expose their portfolio to greater risk. For example, if you are in your late 50s, you would ideally not want to lose your money and your risk taking ability reduces as you age. But if you are an aggressive investor and in early 20s or 30s, you can avoid this principle, but then you should ensure that the stock is fundamentally sound and you only invest when it is trading below 200 DMA, and stick to 5% principle and stay diversified. Now you can question, how does this become a 3-3 risk minimization strategy? So let me add a new layer to this: how, when and where. So essentially, overall strategy answers 3 key questions in portfolio building, which is how to buy a stock, when to buy a stock, and from where should we buy the stock. So this completes my 3-3 risk minimization strategy and the underlying principles. That's all for today. Thank you everyone.